The complete commercial financing roadmap from acquisition to exit. And every successful commercial real estate investment begins long before closing day. And experienced investors understand that financing isn't a single event. It's a strategic roadmap that evolves throughout the entire life cycle of a property. And the financing you choose at acquisition can directly influence your renovation budget, your cash flow, your refinance options, your tax strategy, and your eventual exit. So, whether you're buying your first investment property or managing a growing commercial portfolio, understanding each financing stage can dramatically improve your returns. So, here's the complete commercial financing roadmap. Stage one is acquisition financing, and everything begins with purchasing the right asset. And typical financing options can include conventional commercial loans, an SBA 7A, an SBA 504, and bridge loans, and agency multifamily loans, and life company financing, and credit union financing. And the best loan really depends on the actual property type and the occupancy, but the borrower's experience, their credit, the cash flow, the loan size, and its business purpose. And an experienced capital advisor shops hundreds of lenders instead of forcing every deal into one single bank's credit box. So, stage two is value add and construction financing. And many properties require improvements before reaching their full value. And some common financing there would include, say, a construction loan or a bridge loan or rehab financing or build to suit financing or ground up development loan with some C-PACE financing attached or mezzanine financing or preferred equity. And some capital improvements that are common might be, say, replacing a roof or HVAC upgrades or parking lots or interior renovations or tenant improvements or energy efficient upgrades. And proper financing allows investors to preserve liquidity while also increasing their asset value. So, stage three is stabilization. And after renovations are complete, the focus shifts towards increasing the occupancy and improving cash flow. And lenders are now going to evaluate the net operating income or NOI, but also the debt service coverage ratio or DSCR, the occupancy, tenant quality, lease terms, and the property management. And this stage often determines whether refinancing becomes available. So, stage four is permanent financing. Once stabilized, investors frequently will replace that short term debt with longer term financing. And some benefits there include you'll generally get lower interest rates with fixed payments and longer amortizations, and usually improved monthly cash flow. Or you're extracting equity, or you have reduced refinance risk because you have better terms now. So, common permanent lenders would be, say, a bank or a credit union or a CMBS or an agency lender or a life insurance company. Stage five is portfolio expansion, and experienced investors leverage existing equity in other properties to acquire additional properties. Some strategies there may include a cash out refinance or a cross collateralization or a blanket loan or a portfolio loan or an equity partnership or a 1031 exchange. And proper financing transforms one property into an expanding investment portfolio. Stage six is asset optimization, and as markets change, financing should evolve as well. And owners continually evaluate rate reductions and loan modifications and supplemental financing, but also working capital and equipment financing and tenant improvement financing. And small financing decisions often produce significant increases in investor returns. Stage seven is your exit strategy. And in every investment, it's eventually going to reach its exit. And some options to include there would be, say, selling the property, and you can capture the appreciation and reinvest your capital. Or you can refinance and retain ownership while accessing the accumulated equity that you've built up by loan paydowns and increase in property value. Or you could do a 1031 exchange and defer your capital gains taxes while upgrading into a larger investment. Or you can hold long term and continue generating passive income through stabilized cash flow. And planning the exit early often produces significantly higher after tax returns. So, why financing strategy matters? Well, many investors focus exclusively on interest rates. whereas professional investors will also focus on the loan structure and flexibility and prepayment penalties and recourse versus non-recourse. And can we refinance later? And can we preserve our capital? Are there growth opportunities? And the right financing strategy can generate substantially greater wealth over time than simply just choosing the lowest advertised interest rate. So why work with CommLoan? And at CommLoan, we help borrowers access hundreds of commercial lenders through one streamlined platform. So whether you're financing multifamily or industrial or office or retail or hotels or self-storage or medical or churches or mixed-use construction, we can help you identify lenders whose programs best match your property and your investment objectives. So instead of fitting your deal into one lender's requirements, we match your deal with lenders who are actively seeking opportunities like yours. So, final thoughts for the day is that commercial real estate financing doesn't end at closing, and the most successful investors are continually optimizing their financing throughout their acquisition and stabilization and expansion and refinancing and the eventual exit of that property. So, with the right financing roadmap, every stage becomes an opportunity to build wealth while also reducing your risk. So, the question is, are you ready to finance your next commercial investment? Well, if so, I'm your guy, and let's build your financing strategy together. My name's Bill Rapp. You can visit my website at billrapp.comloan.com. You can start a pricing quote and also schedule a consultation so that way we could have a conversation. That is it for the day. Thank you for watching. Take care.